Afternoon, everyone. Welcome to our Monday market picks. This is 20th Jan. Sorry for the delay and wait due to our technical difficulties. And this is Jack here, and I'm wishing you a very profitable 2025 ahead. So what an interesting week this week has been, which ended with S&P posting the best week since period following Trump's election. Trump will also be inaugurated in the next few days, of which the market is expecting tariffs and also friendlier policies to boost US oil and gas production. Firstly, we launched our 4th edition of the Maybank Feng Shui Guide to Prosperity as we usher in the year of the wood snake. The guide utilizes the secret of the stars to predict winning investments, and I will share more about this later. Next, my Indonesian colleague Joycelyn who has initiated on the Indonesian poultry sector with a positive view, and she will share her views on why she is positive on this sector. We will then move on to Natasha, who will elaborate on her findings after her site visit to IHH. And lastly, we will hear from Eric as he reckons that while earnings for private healthcare companies have more or less bottomed, we will still need to see more visible growth catalysts to drive stock re-rating. So let's start with Singapore. Firstly, we have launched our 4th edition of the Maybank Feng Shui Guide to Prosperity as we usher in the year of the wood snake. This guide utilizes the secret of the stars to predict winning investments. And in 2025, 3 out of 4 of the elements are in nature. And we expect 2025 to be female-driven in direction, ideas and strategy, as the in-wood by nature clings on to strong structures to thrive. And we can also expect collaborations, compromises, and also disgruntlement ahead. This year's dominating energy is the Cygnus star, and we are also expecting more heat waves, flash fires, and haze in 2025. With potential virus outbreaks from Central China, Africa, and the Middle East. As Master Ken Cole said, remember to keep on your mask, especially in crowded places or when you are traveling. Fire is also a symbolic of optimism, hope, economic growth, and drive. Stocks, equities, and finance are in sterling position, and Southeast Asia will be a big beneficiary of this strength. I think this is some optimism ahead of our SGX MAS review, which could be quite positive for our stock market. Notwithstanding 2025 is bound to be a year of unprecedented geopolitical uncertainty. We expect sectors such as banking, real estate, construction, REITs, energy, telecommunications, and internet to present new opportunities for investment. The top zodiacs this year seems to be rat, tiger, horse, dog, and monkey. For more info, please refer to our Feng Shui report that we have published earlier. Now, let's talk about the Indonesian poultry sector. Justin, are you there?
Hi, Jared, I'm here.
Hi, Justin. Can you share more about why are you positive on this sector? And also, what are your top picks?
Okay, so we're basically positive towards the sector due to 2 reasons. The first one is because of the low base poultry consumption in Indonesia, and second reason is because of the government's support to protect the industry. So in regards to the first reason, which is low base poultry consumption, looking at Indonesia's poultry consumption is only about 8 kilograms per capita. Whereas if we compare it to Malaysia, which reached 50 kilograms per capita, and Vietnam 17 kilograms per capita, Indonesia's number is quite low. So as we believe Indonesia's population and GDP per capita will continue to rise in the future, poultry consumption should also increase in the future as consumers shift their preference from cheap plant-based proteins such as tofu and tempeh to animal-based proteins such as chicken. On top of that, the growing number of modern trade channels should also support Indonesia's poultry consumption because ready-to-eat products and carcass chicken are seen to be more practical and saves a lot of time. And the most important program in 2025 is Prabowo's Free Nutritional Meal Program, or what we shorten as NMP. This NMP program should increase the poultry consumption by 25% year on year in 2025. And actually, this program will also be targeted to 80 million people by 2027. So we are forecasting that the poultry consumption should continue to increase in the next few years. And second reason, which is the government's support to protect the industry, the government have implemented a grandparent stock quota of 530,000 birds in 2024, which is the lowest quota in the past 9 years. And also, the government have appointed 20 giant breeders to voluntarily cull their parent stock at the age of 50 to 54 weeks, whereas previously 67 weeks. So this should protect the live bird price and also control the oversupply in the industry. In regards to our topic is Japfa. And the reason behind that is because of the aggressive earnings growth, which we forecast to be 222% in 2024 and another 20% in 2025. And what drives the earnings growth will be the efficiency that the company, which is Japfa, will do in the future, which is they will procure wet corn and dry their own corn. And they will also continue to implement KPI for each of their managers in each business segment. So there will be cost efficiency in the future. And also, we like Joppa because of its attractive dividend yield of 6%, whereas CPIN at 2% only. And lastly, we also like Joppa because of its attractive PE, which is only at 6 times 2025 PE, whereas CPIN at 21 times PE.
Thank you, Justin. Are there any key risks that you can see that would, turn the sector around, or any key risks that you will foresee going ahead for your positive call?
So basically, for the NMP program, it's still on pilot, and it only started since 2 weeks ago. So we'll have to see further how this program will go in the next 1 year. And also maybe another risk is the price of raw materials such as corn and soybean meal.
Thank you, Justin. Thanks for sharing.
Thank
Next,
you.
we will move on to Natasha. Natasha, are you on the call?
Hi, yes.
Hi, Natasha. Thanks for joining us. Can I check what are your key takeaway from the IHH site visit?
Yes, hi. So we came away positive after our visit to IHH's portfolio of Penang hospitals. We were most impressed with Island Hospital, especially on its niche of medical tourism and the growing potential that it has in the oncology segment. So Island Hospital's ownership of the latest technologies, such as the PET scan machine that we use for cancer detection, as well as the True Beam radiation machine that we use for cancer treatment, enables IHH's other Penang hospitals, the likes of Gleneagles Penang and Pantai Penang, to optimize patient retention via cross-referrals to Island. So previously, they would have lost that segment of patient. The cancer segment is also a good attraction for Indonesians, who happens to be Malaysia's largest demographic of medical tourists, as they make up about 70% of Island Hospital's total foreign market for the oncology segment. This reaffirms our view on IHA's strategy to acquire the hospital. Recall that Island was actually acquired at about 3.9 billion ringgit, which is 19 times our FY24 EV/EBITDA, with the prospects of raising its Malaysia revenue growth and EBITDA margins. Our forecasts had assumed a 6.3 of revenue ringgit and 1.58 B of EBITDA for IHH in Malaysia for 2026, of which Island should contribute about 880 million to revenues and 265 million to EBITDA. Our buy rating and TP of about 7.97 on IHH is maintained, and we continue to like IHH as the current demographic shifts towards a wealthier and aging population. This will then continue to drive growth in inpatient admissions and revenue intensity, and will secure a long-term growth for private healthcare operators such as IHH. History has also evidenced that private healthcare is a very defensive industry, in addition to being a growing one in Malaysia, particularly. Furthermore, we gathered that IHH's valuations are currently ripe for a re-rating in 2025, with the touted listings of Sunway Healthcare Group, which is currently not listed, and Columbia Asia Healthcare, which is also not listed. So that is all from me.
Thank you so much, Natasha. And next, I'll move on to Eric. Eric, I noticed that you are neutral on IHH Healthcare. Can you share why?
Hi, Jared. Thanks for having me. Yeah, as you already pointed out, the sector has been in the downturn for about 2 years since their profits peaked in FY22, along with the gradual phasing out of COVID-19 services such as PCR tests, managing of vaccination center, etc. But despite the borders reopening in 2023, we note that the Singapore medical tourism has failed to pick up the slack, given keen regional competitions, particularly Malaysia and Thailand, high costs, and a strong Singapore dollar. So, in fact, this led to normalization of revenue for the private healthcare providers and was further weighed down by margin compression due to the negative operating leverage and inflationary pressures, such as rising staff costs and utility expenses.
Okay, Eric, thank you. Basically, next is also what are the catalysts needed to turn this sector into a positive one in your view? Like, you know,
Yeah,
what
so
we see.
although we think that the earnings have more or less bottomed and valuation are looking more decent at this level, we probably hope to see more stronger growth catalysts in order to drive a sector re-rating. For reference, I think we think that the China remains the wild card. We hope given the in the upcoming set of FY24 results, we want to see whether China operations continue to grow their patient volumes, leading to a narrow gestation loss. So we also be alert to any updated management guidance for its target of achieving EBITDA break-even for its Shanghai and Chongqing hospital by end of this year. For Thomson Medical and QM, we think that they probably still need some time because as they are growing their new growth engines, Thomson, as you remember, they did a big acquisition of FV Hospital in Vietnam last year. So in the short term, their bottom line is dragged by high finance costs and continued investment in other digital initiatives as well as specialty centers expansion in order to increase patient offering. So we think that, but that said, we think that the second half, Thomson should record sequential growth on better bed occupancy, especially after the completion of its renovation at Thomson Medical Center. For Q&N, we expect the company to book about 3 to 4 million of non-cash impairment charges for its 51% owned Acumen in the second half results, given the expiry of its laboratory license services. But excluding that, I think the core dental business is still doing okay. And in the meanwhile, they are also doing dental AI, so that will also provide another growth pillar for Q&M, as well as they are looking at potential accretive acquisition in Singapore and China. So these are some of the catalysts we think that will drive a re-rating.
Okay, got it. Thank you so much, Eric. So with the sickness star upon us, you know, maybe the healthcare sector is something to keep a close watch on for the second half of this year. So upcoming dates and events, we have the 21st Gen monthly macro call on Asian macro, navigating the trade war 2.0. And also we have a host of results upcoming in Singapore soon, starting the REIT sector. So thank you for your support and have a profitable trading week ahead. Thank you.